Welcome to the Deep Dive, presented by Finbot Insights. This is where we immerse ourselves in, well, intricate financial strategies and some pretty profound market insights. Today, we're embarking on a really detailed examination of strategy. You probably knew them as MicroStrategy and their truly unique approach to corporate treasury management.
That's quite something.
It really is. Our mission in this deep dive is to meticulously unpack how strategy leverages a, let's say, sophisticated array of capital-raising techniques specifically to acquire Bitcoin.
Right.
And the aim is to provide what they actually term Bitcoin yield to their shareholders.
Yeah.
We'll navigate their core thesis, dissect their financial instruments, and rigorously analyze their risk management framework.
All to deliver a comprehensive understanding for you, our listener.
Exactly.
And this company, it really presents a fascinating case study in modern corporate finance. They're venturing, way beyond the traditional confines of balance sheet management.
Right.
To integrate a volatile asset, yes, but one that's potentially appreciating this digital asset, Bitcoin, right at its core.
It feels like a paradigm shift, doesn't it?
It absolutely is. A paradigm shift in how a public company can manage its treasury. And it definitely deserves thorough scrutiny to really understand the nuances and, frankly, the implications for the broader financial landscape.
Okay, so let's begin by truly unpacking their core thesis. What's really driving this?
Well, at the very heart of Strategy's operations, there's this fundamental conviction.
Which is?
That Bitcoin represents the superior long-term store of value, especially, amidst what they see as the pervasive debasement of fiat currencies.
Okay, so the money printing argument, essentially.
That's a big part of it. This foundational belief underpins their decision to convert corporate cash and even future cash flows directly into a Bitcoin treasury.
Instead of just holding dollars or buying bonds.
Precisely. Rather than passively holding depreciating dollars or investing in what they likely view as underperforming bonds, it's a bold departure from conventional wisdom, definitely.
And it's predicated on this belief in Bitcoin's role as
digital gold. Digital gold, an inflation hedge, a superior reserve asset, all of that, particularly in a world where monetary supply keeps expanding.
So this conviction isn't just a belief, it's actively driving their strategy.
Oh, absolutely. It actively drives their overarching long-term goal. Strategy aims to employ what they themselves refer to as a flywheel financial mechanism.
A flywheel, meaning?
Meaning they're continually augmenting their Bitcoin holdings. They use a diverse array of capital-raising methods to just keep adding more Bitcoin.
So it's not just buying a chunk and holding?
Not at all. This isn't simply a one-time acquisition or even just a series of isolated purchases. Think of it as a perpetually expanding accumulation process.
Designed to compound their Bitcoin stack over time.
Exactly, allowing them to gain an ever-increasing share of the finite Bitcoin supply. The real genius here, if you want to call it that, lies in creating this self-reinforcing system.
How so?
Well, each successful capital raise fuels further Bitcoin acquisition. That, in turn, strengthens their balance sheet, which then makes future capital raises potentially even more attractive or easier to execute.
Okay, so it feeds itself.
Yeah.
But what does this mean for the shareholders? What's the mission to them?
Right. Strategy's primary mission for its common stockholders is pretty explicit. They aim to deliver long-term value, specifically looking at a 5-year-plus horizon, and crucially, to consistently outperform just holding Bitcoin directly.
Outperform Bitcoin itself.
How? That's where this proprietary metric comes in. They develop Bitcoin yield.
Yes, you mentioned
And
that.
it quantifies the rate at which the company increases its Bitcoin holdings per share.
Per share. Okay, that's key.
It is. This means investors are promised, effectively, more Bitcoin per share through holding Strategy stock than they could obtain by simply buying and holding spot Bitcoin independently over that same period.
That's a very intriguing proposition. It suggests their financial engineering, their flywheel, can provide an edge beyond just the raw price appreciation of Bitcoin.
That's exactly the claim. This Bitcoin yield is the central promise. It's what differentiates Strategy from just being a simple Bitcoin proxy, like an ETF might be.
Right.
It implies that through their strategic financial maneuvering, they can grow the amount of Bitcoin attributable to each share you hold beyond what simply buying and holding BTC yourself would achieve.
Okay, so that really sets the stage for understanding how they do this. These sophisticated mechanisms they employ to raise capital and actually achieve this Bitcoin yield.
Precisely. We need to delve into those now, exploring how each financial instrument plays its part in this, well, pretty ambitious accumulation strategy.
All right, let's examine these capital raising strategies, starting with the most direct one, Common stock. The ticker is MSTR.
Mm-hmm. The sale of company equity, common stock, represents Strategy's most, let's say, fundamental method for raising capital that's specifically dedicated to buying Bitcoin.
And if you hold MSTR, you are the direct beneficiary of this Bitcoin yield concept.
Correct. You're participating directly in that potential upside.
And a key tool they use here is something called the At-the-Market Offering Program, the ATM.
Yes, the ATM program. It's very important for facilitating efficient equity issuance. This program lets Strategy issue common stock directly into the open market at whatever the current prices are through a designated broker.
So they can sell shares opportunistically.
Exactly. It optimizes capital acquisition as market opportunities arise. It allows them to tap into market demand almost seamlessly without needing these large, potentially disruptive, pre-announced secondary offerings.
Now, normally in finance, issuing new stock raises red flags about dilution, right? Existing shareholders own a smaller piece of the pie.
It's the classical finance concern, yes,
Yeah.
dilution, where your existing ownership stake gets spread thinner across more shares, theoretically reducing the value per share.
But Strategy says these sales are accretive. How can selling more stock add value per share?
It's a crucial distinction, and the reason lies in MSTR consistently trading at a premium to its underlying Bitcoin holdings.
Okay, explain that premium. What's MNAV?
MNAV stands for Market Net Asset Value. It represents the market value of the Bitcoin Strategy holds. MSTR stock often trades significantly above this value. For instance, if MSTR trades at, say, a 2x MNAV.
Meaning the stock price implies the market values their Bitcoin at twice the actual spot price.
Exactly. That premium reflects the market's belief in Strategy's model, maybe its operational leverage, or perhaps just its accessibility as a regulated way to get Bitcoin exposure.
So how does selling stock capture this premium and become accretive? Let's break that down. How does issuing more shares magically grow the Bitcoin per existing share?
Okay, think of it like this. When Strategy sells a share of stock at that premium price, they receive more cash than the underlying Bitcoin per share is actually worth at spot.
Right.
They take that cash, including the premium captured, and immediately buy more Bitcoin. Because they received more cash per share sold, due to the premium, they can buy more Bitcoin than was notionally represented by the share they just sold.
So the total Bitcoin stack grows faster than the share count increases because of that extra cash from the premium.
Precisely. It functions as a rather elegant form of arbitrage. They capture the market premium and convert it directly into hard assets Bitcoin on their balance sheet.
So using that example from the source, MSTR trading at 1.82 times premium, $422 market value per share, but only representing maybe $232 of actual Bitcoin per share at spot.
Right. In that specific instance, selling one share of MSTR brings in $422, but that share only represented $232 worth of Bitcoin.
So the difference, about $190.
That $190 premium is captured. They use the full $422 to buy Bitcoin. So for every share they issue, they're adding more Bitcoin to the total pot than that new share technically diluted. The Bitcoin per existing share actually goes up. That's the accretion.
It's a clever mechanism, leveraging market perception and demand.
It really is. And it's important to understand MSTR's position in the capital structure, too.
Right, it's at the bottom.
Common stock is the lowest offering, yes. In a hypothetical liquidation, bondholders and preferred shareholders get paid back first.
So it carries the most risk in that sense.
It does. But it's also deliberately designed to be the most volatile and potentially the fastest growing offering in Strategy's portfolio. It aims for explosive growth if the strategy works and Bitcoin appreciates significantly.
And this volatility affects its options market.
Immensely. Its large historical implied volatility, the IV, leads to elevated premiums for options contracts. High FI means the market expects big price swings.
Making the options valuable for traders.
Yes, and it creates a very deep liquid options market, much larger than you'd expect for a company of its market cap. This liquidity itself can be beneficial, attracting more institutional players.
Okay, fascinating. Let's shift gears now to another instrument. Convertible bonds. You mentioned intelligent leverage.
Yes. Strategy employs leverage by borrowing fiat currency to acquire more Bitcoin. They frame this conceptually as shorting fiat.
Shorting fiat. Betting against traditional currency.
In a way, it's a compelling idea if you believe in the backdrop of global government deficits and, the perceived necessity for ongoing currency printing or debasement. It's a strategic bet on fiat's diminishing purchasing power compared to a hard asset like Bitcoin.
And convertible bonds are the tool for this. How do they work?
They're interesting hybrid instruments. They combine features of both debt and equity.
How so?
Initially, they're issued as bonds. Strategy is obligated to repay the principal at maturity and often make periodic interest payments, the coupons.
Standard bond stuff.
Right. But the crucial part is that the bondholders also possess an embedded option. They can choose to convert their bonds into a predetermined number of Strategy's common stock, MSTR, under specific conditions.
So, downside protection like a bond, but a potential equity upside.
Exactly. And it's worth noting, the convertible bond market isn't huge, but Strategy has become a massive player in it. Something like 30% of the entire U.S. market in 2025, according to the source.
Wow, that's significant.
It demonstrates how aggressively and successfully they've tapped into this niche but powerful financial instrument.
Understanding the specific terms seems vital here for grasping their risk management.
Absolutely critical. For instance, the source notes that current MSTR stock prices often trade above the conversion price for many of these bonds.
Meaning conversion is already attractive for bondholders.
Potentially, yes. Also, their maturities are strategically staggered, spread out from 2028 to 2032.
Why stagger them?
To avoid one single massive debt repayment deadline hitting all at once, it mitigates refinancing risk.
And they can also force conversion.
Yes, under certain terms, Strategy has the ability to force conversion into shares on an agreed-upon date. This gives them significant control over their capital structure. They can convert debt to equity when it's advantageous, perhaps when MSTR is trading at a high premium.
So what are the main strategic advantages of using these convertibles?
Several key ones. First, they are unsecured. The principal repayment isn't directly tied to their Bitcoin holdings. There's no collateral involved in that sense. And crucially, there's no liquidation price or margin call.
That seems huge. So even if Bitcoin's price crashes,
they aren't forced to sell their Bitcoin treasury to meet a margin call, unlike a traditional collateralized loan. This protects their core holdings during volatility.
okay, that's a major safety feature. What else?
Second, the conversion mechanism allows them to secure very cheap debt low coupon payments. The equity option subsidizes the debt cost.
Right.
And this effectively lets them perform what the source calls a superior common stock ATM.
How is it superior?
Because they raise the cash via the bond now to buy Bitcoin, but the shares are only issued later upon conversion. If Bitcoin's price has risen in the meantime, or if they bought Bitcoin cheaper initially, they essentially acquire more Bitcoin per share they eventually issue compared to selling stock directly at that later date.
So the bonds become more accretive because the Bitcoin was acquired earlier, potentially at a lower price.
That's the idea, making the ultimate conversion more favorable to existing shareholders' Bitcoin per share.
But you mentioned they might be phasing these out.
Strategy has stated an intention to phase out convertibles, yes,
Okay.
citing they're less flexible compared to preferred shares, which we'll get to.
Okay.
They seem to expect current convertibles to be converted to stock by around 2029. But interestingly, there's even speculation about future possibilities, like negative coupon bonds.
Negative coupon. Bondholders would pay Strategy. Why would anyone do that?
It sounds counterintuitive, I know, but it relates to sophisticated institutional strategies. Large firms engage in what's called convertible bond arbitrage.
Okay, briefly, what's the core idea there?
Essentially, these firms buy the convertible bond, but simultaneously short an equivalent amount of Strategy's common stock. They aim for a delta-neutral position.
Delta neutral, meaning their overall position isn't heavily affected by small moves in the stock price.
Exactly. It hedges out the direct price risk of the stock. By doing this, they can isolate and capture very small, but almost guaranteed, profits derived from the bond's specific terms and the relationship between the bond and the stock, even if the coupon itself is technically negative.
So it's a complex hedge fund play for tiny, safe returns.
Precisely. It appeals to institutions seeking guaranteed returns, however small, especially in low interest rate environments. They aren't betting on MSTR's price. They're playing the arbitrage between the bond and the stock.
Fascinating. So if convertibles are being phased out, what replaces them? Preferred shares.
That seems to be the direction. Preferred shares are another hybrid blending characteristics of stocks and bonds.
How are they different from common stock?
Key differences. They typically lack voting rights, and they don't have residual ownership in the same way common stock does. However, they have a superior position in the capital structure over common stock.
So safer than common, less senior than bonds.
Generally, yes. And a really key advantage of preferreds for Strategy is their perpetual nature.
Perpetual, meaning
Unlike bonds, preferred shares often don't have a maturity date. There's no principal repayment obligation looming in the future. Strategy just needs to pay the dividends.
Which frees them up to hold Bitcoin indefinitely without worrying about repaying the principal used to buy it.
Exactly. It's perfect for a perpetual accumulation strategy. Preferred shares represent strategy's primary vehicle now for engaging with credit markets. Each offering targets a different part of the yield curve, different investor types.
And dividends must be paid.
Generally, yes, dividends must be paid unless specific conditions allow deferral. Some are cumulative, some aren't, which we'll get into. And importantly, each preferred share either has or is planned to have its own ATM program.
For dynamic issuance, just like the common stock.
Correct, allowing them to tap those specific credit market segments as needed.
This move from convertibles to perpetual preferreds seems like a significant refinement.
I think it is. It's about securing long-term, flexible capital without the pressure of debt maturities. It lets them commit fully to the ultra-long-term Bitcoin horizon. It's a critical piece of their endgame vision.
Okay, let's dig into the individual preferred offerings. They seem quite distinct. First up, STRK, or Strike, dubbed Structured Bitcoin.
Right. STRK pays an 8.00% cumulative fixed annual dividend. That's based on a $100 liquidation preference, so $8 per share annually, paid quarterly, $2 per quarter.
Cumulative means missed payments pile up.
Yes, any missed dividends accrue and must be paid eventually before common stockholders get dividends. Provides security. Dividends can be paid in cash or, interestingly, in Class A common stock or a mix.
And it's convertible.
Yes, that's a key feature of STRK. Holders can convert it into Class A common stock, MSTR, quarterly. The initial rate is 1.1 MSTR shares per STRK share.
So if STRK is at $100, that implies a conversion price for MSTR of $4,000 per share. $1,000, 0.1.
Exactly. If MSTR trades above $1,000, holders can profit from conversion. This convertibility is strategic for strategy too. As MSTR's price potentially appreciates significantly, these shares can be converted and thus removed from the balance sheet as preferred equity.
So they raise capital like debt initially, but it can become equity later. Who does STRK appeal to?
Likely hedge funds or maybe risk-averse growth investors, people who want some Bitcoin upside potential but also want that fixed dividend income as a cushion. It's a structured way to play Bitcoin's potential.
Okay, next, STRF, or Strife, called the crown jewel.
Yes. STRF is designed to be the most senior security once the convertibles are gone. It sits at the top of the capital structure, below only debt perhaps. It's positioned as a long-term bond alternative, even a rival to the 30-year U.S. Treasury.
High ambition. What are the terms?
It pays a 10.00% cumulative fixed annual dividend, again on a $100 stated amount, so $10 per share annually.
Also cumulative. What if they miss payments?
The unpaid dividends compound at 10%, plus an additional 1% per annum, and that penalty rate can escalate up to 18% until they're settled. Very strong investor protection.
Is it convertible?
No, STRF is non-convertible. It's designed as a pure income play.
So appealing to very conservative investors.
Exactly. Think pension funds, insurance companies, institutions prioritizing stable, predictable income over equity upside. They want that senior position and the cumulative feature.
Got it. Then there's STRD, or Stride, nicknamed the true junk bond. Why?
Because it carries higher risk compared to the others, positionally. It's the lowest preferred in the capital structure, sitting just above common stock.
But it offers the highest yield to compensate.
Well, it shares the same headline dividend rate as STRF, 10% on a $100 liquidation preference, $10 annually.
So same yield, lower seniority. What's the catch?
The critical difference, STRD is non-cumulative.
So if strategy misses a dividend payment,
They have no obligation to make it up later. It's just skipped. That's the increased risk.
which justifies the same yield as the much see for STRF, or implies it should trade at a discount.
It implies it should trade cheaper, offering a higher effective yield to compensate for that non-cumulative risk. It appeals to high-conviction investors, those really bullish on strategy's long-term success and ability to pay dividends, willing to take that extra risk for potentially higher effective returns.
Okay, finally, STRC, or Stretch, the high yield savings account, or stablecoin.
Yeah, this one's quite unique. It has a cumulative but variable dividend rate. It starts at 9.00% per annum on $100, $9 annually, but it's paid monthly. Currently, the only one paying monthly.
Variable rate, based on what?
It adjusts monthly based on the 1-month term secured overnight financing rate, or SOFR. Think of
Yeah.
it like a floating rate note. There are strict limits on how much the rate can be reduced each month, no more than 0.25%.
It's still cumulative, though.
Yes, unpaid dividends accrue with interest, compounding monthly. It's designed to trade very stably, close to its own $100 liquidation preference.
Who's this for?
It targets the short-dated credit market. Think of it as an alternative to a money market fund, but backed ultimately by Bitcoin, offering a potentially higher yield. It's also callable by strategy.
Meaning strategy can buy it back.
Yeah, they can redeem it for $101 per share plus any accumulated unpaid dividends. Gives them flexibility if rates fall or they want to refinance.
So these four preferreds are the main tools now for leveraging the balance sheet.
For the foreseeable future, yes. The ATM programs allow them to issue dynamically into each specific market segment. The goal is always the same. Issue shares, use the cash to buy Bitcoin.
And the bet is that Bitcoin appreciates faster than the dividend obligations accrue.
That's the core bet for accretion. As long as Bitcoin's value grows more than the cost of the dividends, strategy realizes an accretive gain for common shareholders. The principle remains. Acquire more Bitcoin than the cost in terms of future obligations or potential share issuance. It's that continuous compounding strategy.
Why should someone tracking strategy care so much about these different preferreds?
Because strategy's ability to successfully tap into these diverse, specialized capital markets, often getting favorable rates, directly fuels the engine. It dictates how much Bitcoin they can accumulate per common share. It is the mechanism behind the potential Bitcoin yield.
And how has the market reacted? You mentioned they've traded up.
Yes, the source indicates that all the preferreds have traded up in price on the open market. When a fixed dividend security trades above its par value, $100 here, its effective yield for new buyers goes down.
Meaning the market is willing to accept a lower percentage return.
Exactly. It signals strong demand and allows strategy, when issuing more through the ATM, to potentially raise more capital at a lower effective yield cost.
Does this suggest growing comfort with the strategy model or Bitcoin itself?
It could well do. It raises an interesting question. As the market perhaps views Bitcoin as safer or more stable over time, could the yield premium strategy needs to offer over, say, government bonds diminish even further?
Making their cost of capital even cheaper.
Potentially. It points towards growing institutional acceptance and integration of Bitcoin-related instruments into traditional portfolios.
Let's shift focus slightly to the corporate structure and regulatory side. Who's running the show?
Governance is overseen by a 5-person board. Michael Saylor is chairman, obviously the key figurehead and strategic driver.
His voting power is significant.
As of Feb 2025, around 46.8% based on his stock. Though as more shares are issued over time, that percentage naturally decreases, leading to a wider distribution of voting power.
And other key execs.
Figures like President CEO Fong and CFO Andrew Kang. Importantly, their compensation is heavily weighted towards stock options.
Aligning their interests with common shareholders?
Directly. Their financial success is tied to the success of the company's stock price and, by extension, the Bitcoin strategy.
What about regulatory oversight? Is it robust?
Seems so. The SEC requires independent board committees for audit, compensation, and nominations. Plus, they have independent audits by KPMG, a major global accounting firm that provides external validation of their financials.
What about proving they actually have the Bitcoin? That comes up sometimes.
It does. Strategy's stance, given the heavy government oversight they operate under as a public company, is that public proof of reserves isn't necessary and could even pose security risks like painting a target on their wallets.
So the argument is the regulatory filings and audits are sufficient proof.
That's their position. And it's worth noting, even under Gary Gensler's SEC, which hasn't always been seen as crypto-friendly, Strategy has continued its operations and disclosures without major impediment on this front. The takeaway is, yes, the regulatory framework implies they have the coins. They're subject to rigorous controls.
Now, a really crucial distinction you mentioned earlier. They're registered as a technology company, not a financial institution. Why does that matter so much?
It provides significant flexibility. Operating under tech regulations rather than banking or financial institution rules is fundamentally different.
How so? What are the benefits?
A much reduced compliance burden. They aren't members of FINRA, not subject to things like the Truth in Lending Act or the Fair Credit Reporting Act. This means lower legal and accounting costs related to financial regulation.
Freeing up more capital for Bitcoin.
Exactly. More capital can go directly into the core strategy rather than regulatory overhead. And this classification also grants them access to technology-focused stock indexes, like the Nasdaq Q.
Which is a huge advantage for attracting passive investment flows, right?
Yeah.
We'll come back to that.
A massive advantage.
Okay, just to crystallize the structure, the hierarchy. Bonds at the top, for now, then preferreds, STRF, STRK, STRC, STRD, in descending seniority generally, then common stock, MSTR at the bottom.
That's a good general overview of the seniority. It provides a clear picture for investors of the pecking order in a liquidation scenario and the relative risk profile of each security.
All right, let's pivot to risk management. This is critical for such a strategy. The most obvious risk is Bitcoin itself, right?
Absolutely. We have to start by acknowledging the inherent volatility of Bitcoin and the, non-zero possibility of its value declining significantly, maybe even towards zero, theoretically.
So holding strategy stock carries that fundamental Bitcoin risk.
It does. Anyone considering strategy needs to first assess their own view on Bitcoin's long-term risk profile. Strategy success is ultimately tethered to Bitcoin's success. They are very open about this. It's not positioned as a risk-free play.
And strategy isn't just a simple leverage Bitcoin proxy, especially short-term.
No, it's important to distinguish its performance, especially short-term, from a direct 1.1 leveraged bet on Bitcoin. Strategy consistently emphasizes its long-term focus, that 5+ year minimum horizon for value creation.
The short-term options traders might misunderstand it.
Their priority isn't catering to short-term call option speculation. The strategy is built for long-term accumulation and appreciation.
What about the leverage risk itself? Yeah, it's often cited.
It's the primary perceived risk beyond Bitcoin's price, yes. But the details matter. Strategy's debt obligations, like the convertibles, are generally not callable by the lenders, and they have those staggered maturities several years out.
So no immediate pressure there.
Right. And it's not like they're impulsively managing this leverage. They have a dedicated finance team meticulously managing credit risk, ensuring terms are favorable and maturities are manageable. It's a deliberate long-term approach to debt.
The source mentioned a stress test scenario. How resilient are they?
Yes, the stress test suggested Bitcoin would need to experience a massive crash, over 80%, and then stay down at those severely reduced levels for more than 3 years.
3 years of being down, 80% plus a sport.
Yes, before Strategy would face the kind of financial strain that might force a sale of its treasury Bitcoin.
And is such a scenario considered likely?
Well, speaking from a perspective knowledgeable about Bitcoin market dynamics, such a prolonged and intense depression seems highly unlikely currently. The market has shown resilience and recovery capacity even after major drawdowns.
So that stress test suggests a pretty significant margin of safety built in.
It does. It suggests a design deliberately intended to withstand significant market shocks before the core strategy is truly jeopardized.
Okay, another critique that sometimes surfaces is the Ponzi scheme label, because they need constant capital inflow for the yield. How do we address that?
It's a common critique, but fundamentally misunderstands what a Ponzi scheme is. Let's break it down.
Go ahead.
A Ponzi scheme, by definition, lacks a real underlying asset. Strategy holds Bitcoin, a transparent, verifiable asset. Second, Ponzi's promise safe, guaranteed high returns. Saylor is explicit. The company fails if Bitcoin fails. There's no promise of safety.
Right, they acknowledge the risk.
Third, Ponzi's involve intensive fraud and secrecy, paying early investors with later investors' money. MSTR is a publicly traded company, transparent, subject to heavy regulatory oversight and audits. The complete opposite.
And the yield comes from market mechanics, not fraud.
Exactly. The yield is derived from capturing the M&AV premium, from accretive financing via bonds, and prefers genuine financial engineering and market dynamics, not a fraudulent redistribution of capital.
So where will this constant capital inflow actually come from? Can they keep attracting it?
This is where the scale of the markets comes in. The global equity and credit markets combined are enormous, over $300 trillion, a vast, largely untapped pool for strategy.
And they have specific mechanisms to draw from this pool.
Yes. 2 primary channels. On the equity side, index inflows. This is huge.
Because they're a tech company.
Exactly. Being classified as a tech company gives MSTR access to more indexes, including major ones like the Nasdaq Q and potentially the S&P 500 as it grows.
How do index inflows work?
A company's market capitalization determines its weighting in an index. When a company like Strategy gets included in a major index like the S&P 500.
Which involves trillions of dollars in assets tracking it.
Precisely. Every index fund, every ETF, every 401k plan benchmarked to that index has to buy MSTR stock in proportion to its weighting. It's passive mandated buying.
So as Strategy's market cap grows, potentially fueled by Bitcoin's rise, it triggers more mandatory buying from indexes.
Yes. It's a powerful feedback loop. This creates continuous massive demand for the shares, largely independent of active investor sentiment on any given day.
Okay, that's the equity side. What about the credit side?
On the credit side, their preferred shares, as we discussed, offer competitive, often higher yields compared to traditional alternatives like treasury bonds or corporate bonds of similar quality.
Attracting income-seeking investors.
Exactly. Pension funds, insurance companies, yield-focused hedge funds, they are drawn to the attractive yields offered by STRF, STRK, etc., especially in a world searching for yield.
So summing up the risk management. Manage Bitcoin risk, manage leverage carefully through long-dated, non-callable debt, and tap into massive, passive equity flows and competitive credit markets for ongoing capital.
That's a good summary. It outlines a carefully risk-managed path to potentially capturing significant capital inflows for the foreseeable future, all designed to fuel the Bitcoin accumulation flywheel.
And crucially, what about covering the debt or dividend costs? Does that force dilution?
This is key. The analysis suggests that as long as Bitcoin maintains a long-term compound annual growth rate, or CGR, above roughly 10%.
Which seems plausible based on history.
Plausible, and potentially even lower if the premiums on their preferred shares increase, lowering their effective yield cost. If Bitcoin CGR stays above that threshold, Strategy can theoretically cover its debt and dividend obligations by issuing common stock via the ATM without actually diluting the amount of Bitcoin per existing share.
Because the value of their Bitcoin stack grows faster than the cost of servicing the capital raised.
Precisely. And historically, Bitcoin CGR has never fallen below 15% annualized over any period longer than 3 years, even through major bear markets. That provides a strong historical basis, though obviously not a guarantee for this model working.
It suggests a robust mechanism to keep the Bitcoin yield positive, even while servicing their capital structure.
That's the design.
Okay, this is complex. Let's try a simple, maybe overly conservative example of how this Bitcoin yield might work out for an investor.
Good idea. Let's walk through it. Say you buy one share of MSTR for $422.
Okay.
And at that time, as per the earlier example, there's a 1.83x MEM/NAV premium. So that $422 share actually represents exposure to only about $230.60 worth of Bitcoin at the spot price.
Right, so I immediately paid a premium of $191.40, $420 and $230.60 just to get that Bitcoin exposure via MSTR compared to buying Bitcoin directly.
Correct. That initial premium is the cost you pay for accessing Strategy's model and potential yield.
Now let's assume a very conservative 10% annual Bitcoin yield. What does that mean?
That means the actual quantity of Bitcoin held by Strategy, attributable to your single share, increases by 10% each year. This is separate from any change in Bitcoin's price. It's purely the effect of their accumulation strategy.
So, based on my initial $230.60 Bitcoin exposure, a 10% yield means I gain an extra $23.06 worth of Bitcoin exposure per year at the initial price.
In terms of Bitcoin quantity, yes. That's the yield generated by the flywheel, adding more Bitcoin to your shares allocation each year.
Okay, so how long does it take for that annual $23.06 to pay back the initial $191.40 of premium I paid?
If you divide the premium, $191.40, by the annual yield, $23.06, you get approximately 8.3 years.
So under this conservative 10% yield assumption, after about 8.3 years, the extra Bitcoin I've accumulated through the yield alone would make up for the premium I initially paid.
Exactly. After that break-even point, you would theoretically possess more Bitcoin per share through holding MSTR than if you had simply bought and held that initial $230.60 worth of spot Bitcoin from day one.
Illustrating the long-term value proposition, overcoming the initial premium through yield.
It does, but it's crucial to remember the nuance here.
Which is?
This calculation deliberately isolates the yield effect. It assumes zero growth in the price of Bitcoin itself over those 8.3 years, which is obviously unrealistic.
Right. In reality, you'd benefit from both the yield and any Bitcoin price appreciation.
Precisely. Investors hopefully benefit from both simultaneously: the increasing amount of Bitcoin per share, yield, and the increasing value of each unit of Bitcoin, price appreciation. This potential compounding effect is what truly drives the potential for significant long-term outperformance relative to spot BTC.
Okay, that helps clarify the mechanics. So, wrapping this up, where does this leave Strategy?
Well, Strategy is clearly a pioneer, introducing, as the source puts it, new financial wizardry in response to Bitcoin emerging as this unique, hard asset. We haven't seen anything quite like it before.
The black hole metaphor was used.
Yes, described as a kind of financial black hole that continually attracts and funnels capital from equity markets, from credit markets directly into Bitcoin,
Which increases its own capitalization,
making it eligible for larger index inclusions, giving it more collateral.
enabling further capital raising. The flywheel again.
Exactly. A powerful self-sustaining loop, if it continues to execute successfully.
Positioning them as the apex predator of Bitcoin accumulation.
You could argue that. They have the largest publicly declared stack, arguably the lowest average cost basis due to early buys and accretive financing, and the most established infrastructure and access to capital markets specifically for this purpose.
And the different securities reinforce each other.
That's the idea of the financial flywheel. Each security issued potentially enhances the attractiveness of the others. More Bitcoin collateral makes preferred safer. Growing Bitcoin value potentially drives MSTR higher, benefiting convertibles and common stock. More yield for common stock makes it more attractive. It all feeds back into the system.
So gaining this kind of deep understanding really gives you, the listener, an edge.
I believe so. Understanding strategy's intent and the mechanics requires grasping both Bitcoin's potential role and some fairly complex corporate finance. It's a rare combination. This level of detail helps you see what they're trying to build.
Which leads to that core summary statement.
If Bitcoin wins, strategy wins harder. That really encapsulates the leveraged, accretive bet they've constructed.
Now for a final provocative thought. What are the really long-term implications if this strategy matures over decades? The source mentioned becoming a Bitcoin bank or digital real estate developer. What could that actually look like?
It's speculative, of course, but fascinating. As a Bitcoin bank, imagine strategy offering Bitcoin-backed loans, perhaps prime brokerage services for other institutions wanting Bitcoin exposure, or maybe even issuing stablecoins backed by their reserves.
Using their massive stack as a foundation for financial services.
Exactly. As a digital real estate developer, maybe they construct entirely new financial instruments on top of the Bitcoin network itself. Think tokenized securities representing different claims on their Bitcoin treasury, perhaps utilizing Layer 2 solutions like Lightning for payments or other protocols for DeFi-like applications built on Bitcoin.
So moving beyond just holding Bitcoin to building on it.
Potentially. Transforming raw Bitcoin, that digital commodity, into a spectrum of structured capital applications through their financial engineering expertise. They could even become a custodian or strategic partner for other corporations wanting to adopt a Bitcoin treasury standard.
It really goes beyond mere accumulation then. It hints at Bitcoin becoming a foundational layer for a new kind of financial architecture.
It does, and it raises that profound question. What does it truly mean for the future of finance when a major public company fundamentally redefines its treasury, shifting from a fiat-based balance sheet to one centered around a decentralized digital hard asset? It challenges everything we thought we knew about corporate finance and reserve assets.
A truly revolutionary shift, potentially.
Potentially, yes.
Well, we certainly trust this deep dive has provided you with an unparalleled understanding of Strategy's really innovative financial framework and its ambitious Bitcoin accumulation strategy.
We hope it sparks reflection on the implications, not just for strategy, but for corporate finance and the broader market going forward.
Absolutely. And for more meticulously researched analyses and insights like this into the world of finance, please make sure you click the like button and subscribe to the Finbot Insights YouTube channel.
Your engagement really does help us continue delivering these in-depth explorations.
Thanks for joining us on the Deep Dive.